There are two more cuts to come at the next two meetings, and the Kiwi is still steady. I know we need to get this out here. You've been quoted just in the last 24 hours saying that you believe the RBNZ is at or around fair value, correct?
That's correct. And, you know, a health warning to all viewers and listeners that the future direction is always conditional on the economy evolving as outlined in our economic projections. They're available to everyone. Come and visit our website. We know that we've got a lot of spare capacity in the economy. The economy will be growing and is growing, not spectacular, but around a 2.5% per annum type rate over the course of this year, soaking up that spare capacity, meaning we can have growth, low and stable inflation and declining interest rates.
And Governor Mandy jumping in here as well. So given that you have flagged these two cuts in April and May of approximately 25 basis points, dependent on how conditions evolve, what would prevent those cuts, or what would prevent two cuts?
Yes, I mean, by the way, it's not, you know, the risks are symmetric on the way through there, but narrow. The types of concerns we have are that whilst headline CPI inflation is almost bang on the midpoint, 2%, it's still made up of two stories. One is domestic inflation pressure and the other is traded imported costs. On the domestic side, we're still, you know, our core inflation estimates are still around 3%. They're all declining as anticipated, but they're still elevated relative to that midpoint. So we want to see ongoing downward pressure in the prices of basically homegrown inflation. We're confident we will see that, but having it in the bag will be lovely.
Indeed. So what would be the inflation resurgence risk if the New Zealand dollar weakens even further? And what do the tariffs, you know, and the global trade policy outlook mean for inflation in New Zealand?
Yeah, so just very quickly on the first one regarding the exchange rate, we don't target the exchange rate. We draw a straight line from where it is and do our work around that. You know, inflation targeting is medium term and the exchange rate is freely floating. Relative price spikes driven by exchange rate movements, we should be able to look through those primarily as long as our inflation target is credible. We're more confident of being able to look through them now. We are back in the band and taking activity. Yes, one of the risks that we flag, and we've taken a little bit of insurance on it already, is the global geo-economic fragmentation that's going on, trade barriers being one of the threatening challenges there. We think that's already impacting with regard to uncertainty and hence investment. We have a pretty pasty outlook for investment. It's growing, but only slowly. In terms of what could happen, you know, in the near term, it's $1 each way because it's going to depend what is the tariff, who's it on, and what the immediate price impacts may be. But in the medium term, you know, trade barriers will lower global potential economic growth, reduce overall demand, lead to higher price and inflation pressures. But that's more of a medium-term story. The best thing we can do, which is what we're doing at the moment, is keep inflation near the midpoint and our options open.